People always say we're running out of oil, right? We're not running out of oil. What they mean is we may be running out of oil that we can economically produce at this price.
Yeah.
But until we find a substitute for the actual commodity, prices are just going to adjust to, whatever the capital cost and the cost structure of the business is to produce the amount of oil that the world demands.
Wilkie, welcome to the show. Thanks for joining me today.
Thanks for having me on, Chris.
All right. I've known you really ever since we kind of got out of college and you started your career and have really been at one place forever. So I kind of want to start, how did you kind of get to where you are today and growing up at Goff?
Yeah. So, you're exactly correct. I mean, I've had a couple of different titles over the years, but really feel like I've kind of worked at one place for my career, which is, incredibly lucky to be able to do that, and particularly to do it, under the, mentorship of a guy like John Goff. I mean, he's been incredibly successful. He's taught me a ton about a variety of things in business and in life. But most importantly, he's just a really good guy. He's a humble guy. He's, a fun guy to hang out with. So I just, I've been incredibly lucky to be able to, kind of learn business under his wing. But yeah, I started there in 2007. John had just sold Crescent real estate to Morgan Stanley in August of 2007. It was like the last deal that got done before, the financial crisis. And, so at that time he was starting a family office, and I was, lucky enough to get the invite to come just hang around for a few weeks. And I think that's very much John's style, is just, come hang out and we'll see if there's something you can do. And like a pickup basketball game, as I think he's called it a number of times. So, I showed up, in the fall of 2007, knowing basically nothing about everything. And, I just kind of never left. And, I started out doing a couple of different things, real estate. He had two different, groups. He was kind of looking at personal real estate, and so managed a building in Fort Worth for him that he just owned personally. But he also had a private equity firm that at the time was doing CMBS. So I did a little bit of help on that stuff. I learned a lot, but I certainly wasn't all that helpful, I don't think. But the other thing I was doing was public securities, and so most of our investing exposure while I was there for call it 10 years was public equities. And we'd look at, private deals and things of that nature, but we just felt really comfortable in the public markets. John's always been kind of a public markets guy. And so that's, just kind of where I found my niche. And so I'd call the better part of the first, 7-8 years was generalist investing. It's a little bit, I think, maybe backwards from maybe how most people learn about business, because you kind of learn about it by doing. But I did a lot of learning kind of in theory. So,
what do you mean by that?
Well, we're looking at investing in whatever XYZ company. I can look at balance sheets. I can read financial statements, but like, in terms of really understanding what working capital is, or what a working capital swing is intra-month, or, how you're going to deal with your creditors, or, all those kinds of things. They were concepts that I understood, but not things that I feel like I really understood.
Yeah.
So I did a lot of learning from obviously John, but also, guys like Warren Buffett, Charlie Munger. Really was able to learn a lot about, how to think, and did a lot of work on kind of psychology, because I didn't know a lot, but I was intuitively, at least, I think smart enough at the time to know that, the people who said, well, this stock trades at 5 times EBITDA and this other one trades at 7. So, you buy the 5 and sell the 7. I mean, it's just kind of, well, that sounds silly. I mean, if that's really how this works, then everybody's going to be good at this. So,
yeah,
I was at least smart enough to kind of understand that. And so I guess I learned business from the outside in a little bit more than, you'd normally expect. But Like I said, generalist investing, I didn't do a lot of tech or kind of high growth businesses. It was more hard assets, deep value. I think just by my nature, am a pretty big contrarian, and I think John would probably say the same. So, that was something that I focused on a lot, and kind of found my niche in that part of the world. So I had done just kind of generalist stuff for about 7 years. I had handled the oil and gas investments that we had done during that time, just because we're in Fort Worth, and so just by location are going to see a lot of deals that come through. So I kind of did the underwriting on a lot of those things, and then I would say, particularly as I got more experienced. But John's, style is concentrated investing, and I'm a huge believer in that. It's kind of the, you don't have a lot of eggs in the basket, but you watch the eggs very, very closely. I think was like, I just butchered a Stan Druckenmiller quote, but I can't. It was something like that. So really trying to dig deep, understand businesses, at a very fundamental level, and then bet big when you feel like you've got an edge. So, in 2014, when the OPEC deal happened over Thanksgiving and oil dropped a bunch, as simplistic as it was, we looked at a crude chart and said it was at 110 in August, and it's at 50 now. There's got to be something to do here. And I had enough knowledge to know kind of where to start turning over rocks, I think. So we kind of started with a blank sheet of paper. I took all the rest of the industries that I was covering off my list, and we focused solely on oil and gas investing, starting in, call it January of 15. So started out, mainly buying equities. And we were, the thesis at the time was, if you rewind a year before that, call it spring of 2014, you started hearing these people talking about, multiple benches in the Permian and other places, but the Permian was the main focus. But when you'd look at the math on all these things, it would imply that, hey, if all these benches work, it seems like the market's pricing in a lot of these benches at the time, or they're pricing in higher oil prices, or it's something like that. So it didn't feel like there was much of a margin of safety there. So they had kind of started to preview that, and then oil collapsed, and everybody said, well, forget about all that stuff that y'all were talking about, effective acreage and all that. So that was really kind of the main focus for us initially. And we had two buckets. It was kind of good assets, good balance sheet; good assets, bad balance sheet. And we put some money to work, looked smart for a little while. First 6 months, everything was kind of going up and to the right. And then summer and fall of 15, you had two things happen. One was, oil kind of came back down, and the high yield market rolled over. And so, a lot of the names that we were, focused on, particularly in the good assets, bad balance sheet bucket, where we had really put less capital on the equity side.
Right.
You saw those equities really go down a lot, but the good balance sheets really didn't move much. And so, those same companies who had, less great balance sheets, we could buy their bonds. And I've always liked to focus on small cap businesses rather than large cap. I just feel like if there's, 25 analysts writing on a name, it's really hard to have an edge. You may find it, but I tend to find that, it's much harder. The other thing is, we can, as a family office with just, the Goff family's capital, we could put enough capital to work in those businesses to where we would have a voice, whether it's not necessarily in the boardroom, but, we call management, they're going to pick up the phone. And that was important to us because we did, we didn't always have to agree with, the people we were investing with, but we certainly wanted to make sure that our voice was heard, if we thought there were things that made sense. So, late 15, early 16, we kind of started deploying capital that was in this good assets, good balance sheet, and moving it over up capital structure into unsecured debt on some of these smaller cap names. And the great thing about those was we found that like anything that was under $1 billion of kind of unsecured debt outstanding was too small for any of the money centers to get involved in. So you really saw those bonds collapse. And so, you're buying Resolute Energy was one, Clayton Williams, Um, um, Legacy Reserves was one really, really cheap. But so you're buying these bonds at, 10 to 50 cents on the dollar, and you're looking at yield the worst of, 30, 50, 60%. And so we kind of went from being an equity and business analyst to kind of an amateur lawyer. And so all I was doing for 6 or 8 months was, reading bond indentures and trying to understand credit agreements and how they were all tied together. And really the thesis in that part of the business, or that, kind of phase of our investing period, was I don't want to buy any bonds that, first off, the value's got to be there, obviously. But the second thing is I don't want to buy any bonds where there's a complicated capital structure. I want to know that with reasonable certainty that if anything goes wrong here, this bond is going to be the fulcrum security. Like if you've got a second lien and a first lien and a pref, and you go into bankruptcy and you got to go argue with all these people, I hadn't experienced that before, but I knew that can be very, very expensive to try and come to an answer on, what the fulcrum security is. You usually have to pay a ransom to various other members of the capital structure just to get them to kind of go along. So, did that through kind of 16 or through early 16, and then Q2 of 16. I mean, all those bonds went and traded up to par, with one exception, which was Legacy Reserves, but we bought that one a lot cheaper. So, again, we had a great year in 2016. A lot of people did that were invested in energy, but just had a ton of success doing that. We had become the largest shareholder of Resolute Energy, which was, a big win for us, that ended up selling in 2018. And another one was Texas Pacific Land Trust, which was, kind of a sleepy business. Great. I love it when I find a business, even if it's larger cap, if it's got no analyst coverage, it's kind of like being a small cap. You're not going to have a lot of people who are focused on it. The other aspect that I thought was interesting was just, you don't have a lot of liquidity in that name, or at least at the time. And so, I'm always looking for situations where I know I'm not the smartest guy in the room, but if I don't have competition from professional institutional investors, it makes it a lot easier to find value. And so, we had a lot of good success with the, public markets investing model, but we found that a lot of these businesses did not have high insider ownership. And because of that, it was easy to get the incentives misaligned between the management and the investors in the business. And so, a lot of those investments that we had made were kind of winding down. They had either been merged into larger companies or had sold. And so, we were kind of looking at, where are we going to take this next? Because we still think there's a lot of opportunity here. And, there was a situation, Contango Oil and Gas, which is a public company. We had followed it since I probably first looked at it in 2008, which was, very early in my career. Had a ton of respect for the founder. It was run for shareholders. It was, a very, shareholder friendly structure. And so, it was just a business we had a lot of respect for. It was very tied to natural gas prices. So, we didn't own it because we weren't constructive on natural gas kind of, around that time. And then they ended up, tragically, the founder passed away. They merged with a company called Crescent Exploration, which, in a corporate finance textbook would say Crescent's kind of over-levered, they're oily, this is under-levered, it's gassy. It looks nice to put them together. But, I think we found that net of, kind of the strategic direction that was taken in and the big drop in commodity prices, those that company became, somewhat distressed. And, I think one thing in oil and gas that we liked at the time, and we found this in Resolute Energy, which was, if you can find a portfolio or a company that has a portfolio of assets that, you've got one asset that, is really a growth engine, but you've got something else that nobody likes, but churns a lot of cash flow out. That can be really interesting because people like, at least at the time, people loved pure plays. They didn't want to mess around with, anything that was diversified. And so Resolute Energy had this Aneth field, which was a CO2 flood in in Utah. And then they had this Delaware Basin asset that was kind of, core of the core, at least, very close to it. But you mix the two together and the lifting costs look kind of off and capital intensity still looks kind of high. But we knew if you disaggregate those two things, you've got something that can feed the growth of this asset you really like, but the market doesn't really give you credit for that. So we love that. And good example, I had an investment banker come and meet with me and said, look at all these trading multiples. And, if Resolute gives away this Aneth Field asset, my prediction is that the stock goes up 50% the next day. And I went, look, I get all the math you just put on that page, but don't tell me that giving away a $200 million asset is going to make a stock go up 50%. I mean, I get the math. That's just, I won't ever believe that because fundamentally, I'm just convinced that that's not true. So Contango was a lot like that. They had a very shallow water offshore natural gas asset, and then they had an asset that was in the Delaware Basin that we thought you could fuel the growth of that asset with shallow water Gulf of Mexico. Now that asset in the Delaware ended up being not in the core of the core like the Resolute asset was. We thought the fairway of that play was still maturing, and it was, but it wasn't as core as we thought it'd be. So, but Contango, that was kind of the thesis: is look, they've got an interesting collection of assets. It's a public company, and it's over G&A'd right now. As you can imagine, when these businesses went from 2014 to 2015, you might have had the asset value of these things cut in half or more, but nobody cut their G&A in half. Yeah. And you've got to do that. And, economics 101 tells you, you've got to cut G&A when your asset value drops, or you're just going to kind of bleed to death. And so, there was a shareholder, it was a mutual fund out of Chicago that owned a very large position in this company, which is unusual. But I think that was, they invested based on the founder of Contango. And so, I think they had a lot of conviction in his strategy, and I can't disagree with them. But then, that strategic direction kind of changed when they did the merger, because obviously the founder passed away. This mutual fund, we just called them up and said, hey, do you want to bid on your 20, I think it was 15% at the time, 15% position. They were way down in it because they had owned it since 2012 or so. We thought maybe they'll want to take a tax loss. And, they at first said, no, it's worth a lot more than this. And, we kind of hemmed and hawed. And a couple months later, they called us back. And so we bought that, literally over a weekend. And we went to the board and kind of said, like, we're willing to bid on this, but there needs to be change at this company if we're going to buy this, because we're not just going to buy this and watch what's been going on continue to go on. So bought the position.
And real quick, why would the board, why would they want you to buy it and then change things? Were they in agreement that they wanted change? Like, what if they were clearly doing the things they were doing it? Why would they want to change just because you bought it?
Yeah, it's a great question. It was a little bit of a unique situation. It was a very unique situation. I mean, Contango at the time that the founder died was about $1.2 billion of market cap. They had about $200 or $300 million in net cash on the balance sheet, and they had 8 employees. That's a very unique business. And
wow,
that's another thing that I love looking for in public markets or anything, but public markets is obviously where I spent most of my time, but looking for these really extreme situations. I think that's where you find, outlier companies in terms of, long-term returns.
Yeah.
Crescent was kind of more of a traditional oil and gas company. So, even though Contango shareholders took 80% of the combined business, 80% of the employees, or more than that, came from Crescent. And the board was initially, I think, 5 and 3, 5 Contango board members, 3 former Crescent board members. Well, I think some of the Contango board members, 2 of them ended up saying, yeah, this isn't really for me. They resigned. And so what you had then was you had a 6-person board, which, an even numbered board is a little bit odd in and of itself, but you had 3 and 3. And so I think, it's easy to get gridlocked when you're in that kind of position. And so, when we went to them and said, look, there's got to be a change here, I think they were perhaps looking for a catalyst, and we were able to be that catalyst. So I had, never run a business. I had never managed people other than maybe one at Goff Capital. But over a weekend, John and I went on the board, and I stepped in as interim CEO. And, that was a crazy learning experience.
Well, to be clear, so part of the so you go to the board, you say, I'm going to buy this mutual funds position for 15%. And then you go to the board and you're like, we want to make some changes. So part of the negotiation was, we're going to buy it and we're going to basically take over, and I'm going to be the CEO come Monday morning.
No. So we went to them and said, we're going to bid on this, assuming that, the board is supportive of making changes to this business, because that's what we think needs to happen for this to be successful. And they said, or at least some of them said, yeah, we're all for it. So we bought the position, and then we started talking to them and negotiating about what does change look like here. So we had already we were willing to risk the capital, knowing that they were willing to make changes. And it was, it was really a good, kind of mutual decision. You don't see that a lot. I mean, there wasn't a ton of fighting or anything. It's kind of like, we can do this the easy way or the hard way, and nobody wants to do this the hard way because it's going to be painful and expensive and time consuming and all those things. And so, then it was over a course of, maybe 6 or 8 weeks that we kind of figured out, let's let Wilkie step in. We'll go on the board and then go off to the races.
When you first bought the position, though, did you think that's what it would end up, that you would be CEO, or is that really what evolved over 6 to 8 weeks?
I didn't know that by any stretch of the imagination. I knew that we needed change in the organization, and I didn't necessarily know whether that was, who and what that looked like, but we knew that there needed to be a lot of changes. And so, at some point during that 6 or 8 weeks, I think I told John, like, look, I think I can take this project on. A lot of my other projects are, kind of winding down or in cruise control to some degree. I can still, help out on those things, but, I think I can go turn this thing around. And he said, go for it.
Okay. I envision, you've done like all the preparation work of your career from 2007 to 2017. I envision that video of Tiger Woods where he comes and he's like, hello world. So you get announced CEO, you've managed one person before. That's just kind of a cool story. So what happens like when you kind of have to learn, I'm now CEO of a big organization. How'd you do it?
Yeah. I mean, we weren't that big at the time. We probably had, 25 or 30 people in the office down in Houston, and probably another 40 or 50 out in the field. So it wasn't tiny. I mean, it was obviously much, much bigger than any other,
it's more than one
workforce. Yeah, exactly. It's way bigger than the one that I sort of managed before that. I knew that it was going to be hard, but I knew that I could do it. Or I was convinced I could do it. Maybe I wasn't 100% sure, but
that's awesome.
I knew that I was probably the best positioned person to do it at the time. I wasn't the best, but I may have been the best position.
Yep.
So I, went down to Houston, and we went to a board meeting, and then the next morning they announced the change in position. So then for the next 15 months, the focus was kind of, step one is let's get our arms around the assets and kind of where we're positioned in the market. And step two is, and simultaneously, like, we have got to cut a massive amount of G&A out of this business if we're going to survive. And I knew it could be done, but I didn't know how I was going to do it. Because there's only so much you can know from public filings. And so, I spent the next 15 months. I think the day I started, my oldest daughter turned 5 months old. So I was down in Houston, and for the next 15 months, I went down to Houston on Monday morning and came back on Friday. I didn't see anybody for a while there, but, it was a ton of work, spend a ton of hours at the office and just try and soak up as much as you can. We had, and this was a thing that I think I underestimated, was just the relationship with the bank group that was our main credit line at the time. It was not good. There have been some missteps, and I totally understand lenders' opinion on some of that stuff. I mean, they're the first loss position. They have capped upside, and it just is what it is. So you just gotta figure out how to get them to give you enough time to turn the ship around. So we cut G&A by, I think, between 40 and 50% in 12 months. And it really right-sized that to a position where I felt like, we could be successful. We needed to scale, though. I mean, we needed to scale. And look, the goal with this, once we got in there, we felt like, man, there's going to be a lot of carnage in this business. And what better way to take advantage of an industry that needs to consolidate than just being the consolidator? Now, if you're going to be the consolidator, you got to be willing to be consolidated. And so, I think that was something that I think our ownership position gave us a lot of street cred in, was, look, we're here to run this. We think we can go consolidate up a bunch of assets at the bottom point of a cycle, but somebody comes to us with the right offer, right situation, money's money, and we want to make money on the investment that we've made. So we did that for, like I said, about 15 months.
And real quick,
yeah,
you aligned, you guys, because you said a second ago, like a lot of these businesses just create misalignment. And I don't know if that's like an oil and gas industry thing, or if you see that pretty much in public companies across the board. But I think one of the unique part of your stories, I don't want to skip over it, is how the incentives and alignment you created at Contango that was pretty much different than like the rest of your peer sets.
Yeah, I mean, we the first thing I did when I stepped in was cut the CEO's salary in half. And I think we've tried to maintain that mantra, certainly at the C-suite in our company ever since, is, if you're here for a salary, this is not the right place for you.
Yeah.
I personally had a lot of my own money that I had put in. And that was one thing that I learned from day one with Goff was, I started out, once I got enough, confidence to start going and pitching ideas. But I didn't really know what I was doing. I was kind of in sales mode. And, John, if he liked one, he'd go, okay, well, how much money are you putting in it? And I'd say, well, I don't know. Like, well, I don't want to talk about anything that you don't want to put your own money in. And that was a huge, learning lesson for me, and something that I think I'll always have, as a big thing for me is alignment via ownership. I mean, if people are putting their own dollars in, that's really big. Now, you can't ask a large percentage of your workforce typically to do that in a business like this. So, we try to create that alignment via long-term incentive plans, whether that be stock grants or, PSUs, which are like stock grants, but a little bit more leveraged. Better if you do well, not good if you don't do well. And I'm totally fine with, making those bets. So, that's something that we continue to this day. And I didn't even ask, once I got in there for a couple of weeks, and, anytime somebody said, let's talk about compensation, I'd say, we're not there yet.
Yeah.
I don't, I got so much stuff to fix right now. We need to, let me focus on this other stuff. We'll get back to that. And so, there was such a trust factor between me and Goff that I just never worried about it. I mean, we never had, at Goff, we never had really anything on paper. I mean, it was, here's your salary, and we'll figure out how we did at the end of the year, and we'll figure out how we divvy that up. And I never really worried about it because, we might disagree, but I knew that he was going to treat me fairly, and I trusted him. And so, when I was working for those couple of years, and I didn't really have any options there, or stock options, I mean, I just didn't worry about it. I knew we'd figure it out. I knew if I did a good job, I would get compensated for it. And
that's huge.
So, yeah. But we try to do that in the company now, and the company was, when it was standalone, the long-term incentive program, we wanted to make sure that every single person in the company, from lease operator, pumper, all the way up to the C-suite, was getting, ownership in this business, and we wanted them to be thinking like owners, because I think it's the most important thing people can be thinking about other than being safe.
Yep. Okay, so you cut you cut overhead. You spend 17 months or 15 months kind of turning around. Compensation, incentives are right. Now what's happening?
Yeah. So at this time, I mean, the market's getting really nasty. And it's funny. I mean, this was in 2019. So it wasn't even like prices were really that nasty, but the bank market was really nasty. And so this is, pre-COVID, but we're starting to see a lot of these businesses that, I would say in general kind of borrowed money to drill, and they drilled in the wrong places. And that can get you turned upside down really quickly in oil and gas. So we're seeing a lot of these situations. And at the time I'm talking to, who's now our president, Farley Dakin, a ton about this. He took over a distressed situation that was, essentially owned by banks, and worked that situation out. And so he was all of a sudden in the oil and gas business. His entire career had been, turnaround and restructuring, but as a service provider. So he'd swoop in when, XYZ private equity company had a second lien that, was about to blow up because the company was either fraudulent or just underperformed or whatever, and had to go kind of figure everything out. So he was used to being in that chaotic environment. And, again, I feel like, to the extent I do things good, one of the best things that I do is being able to, and in really chaotic environments, to be able to kind of see, where we need to go rather than running for the hills. And so I'm talking to Farley, almost every day at this point about things we're seeing, deals he's working on, deals I'm working on. And we ultimately decided, why don't we put these two things together? We'll buy your business. You come on and help us. There was going to be a lot of distress at the time. And so we knew that, his skill set was going to be one that's not, that whole turnaround restructuring business is very, cliquey industry. And it kind of, as distress will move from industry to industry. And so, I don't think the players in those industries are typically not the best people to understand how to capitalize on bankrupt businesses, right? Because they don't know the rules of the game. They know the rules of the game that they were playing, which is oil and gas operations, but they don't know how to deal with a bankruptcy court. So, we bought his business, brought him on, and, a deal that he was bird dogging at the time was White Star Petroleum. And so
you got to tell the whole story.
I will. So, I think we signed the deal to buy his company and kind of re-rack our business with a new credit facility from
And can I stop you for 1 second?
Yeah.
Because I think what we're about to talk about is important. Will you just tell real quick, what is the mission of Contango? Like, what is y'all's goal, and how does it differentiate y'all from maybe other upstream operators?
Good question. So, I think most of our focus is around the acquisition of assets, and they tend to be lower decline and more mature.
Okay.
And
in basins all over the country?
In basins all over the country. I mean, I would say predominantly we are conventional Permian, conventional Wyoming, and then the mid-continent area. But, we tried to be reactive to value. Now, obviously, we're not going to go buy $1 million deal in, California or something, because we don't, if it's some brand new area, we need a little bit bigger deal to kind of put a beachhead there. But we tended to buy production. And what we noticed was, if you analyze the G&A of a lot of these businesses, at least at the time, and I think it's still the case, the G&A is so heavily skewed towards your development capital. So your geologists, your big land teams, your land brokers, your, drilling engineers, completion engineers. I mean, you look at like the percentage of G&A that's spent on development capital is massive. I mean, 80, 90%.
Wow.
And we're looking at the market, the valuations, and we're saying, look, most of these companies, at least the ones that aren't in the Permian or some, sexy basin, are trading at or below PDP value. So why would you have all this G&A unless you were just really, and look, if you're really convicted that I can go drill a bunch of wells and create better value than via acquisitions, then you should do that. I think that's really difficult to do in small companies.
Okay.
And we know guys who have done it excellently, but that's not really how we're geared. So our view was, look, if we go buy a business, we should be able to cut 80 to 90% of the G&A out and keep all of what we want, plus all the call options on future drilling. And so that's really the niche that we've tried to carve out is, buy assets, focus on trying to optimize OpEx rather than CapEx, which is, not what most people are doing. And we're willing to accept higher lifting costs because of that. I mean, typically these mature and conventional assets, lower decline assets, White Star happened to be unconventional, but it was in, kind of terminal decline. We would, what we say is we'd gladly trade higher lifting costs for lower capital intensity.
And real quick, so you say this is a just dumb question. We can take out 80 to 90% of the G&A, but we have, you said, the call options on future development. How would you develop it if you've cut out that G&A? You already have the infrastructure built. You don't need more of it every time you buy a company.
Yeah, that's right. I mean, essentially, so, if we already we're not doing, much drilling at the time when we bought White Star. We were doing a little bit, but, our view was we don't need 3 drilling engineers. I think the one that we already have who we really like can handle this. And if we need to backfill with additional people, then let's do that. But, in a lot of cases, you're buying leases that are HBP'd. And so all those future drilling locations I viewed as free call options that I'm picking up along with the assets. Now, some of the leases expire sometimes, and now you can't go drill that or you got to go release it. And that's a different equation. And some of that happened. I mean, it's bound to happen in some of these things. But, we just found that, the accretion to scale was very, very real. If you can buy assets that are, at a discount to, what you view as the value of the production.
Okay. So now we know what Contango does. Let's go back to Whitehorse, because anybody listening is your White Star. It's just a cool story.
Yeah. So White Star, we, again, Farley had, I mentioned earlier that Farley had kind of taken some bad credits out of a bank and had managed them and kind of had stepped in as a fiduciary to operate those assets. As you can imagine, they were in disrepair. He was able to go in and kind of, without much oil and gas knowledge, fix these things up and improve the operations of them. And so it was I wouldn't call it a huge win for the banks, but it was much better than what was going to happen if he hadn't stepped in. And so, that was a smaller deal. This White Star had, I think, $1.2 billion of invested capital. They had a $325 million first lien. They had a $50 million second lien. So there was a ton of capital that had been spent on this deal. And I want to say it was 18,000 barrels a day, at the time. And so that was a much bigger deal than the one he had done before. But, the bankers had talked and heard that Farley was working on this. So they reached out to him to say, do you think you could do that with this situation? Because we may need to credit bid this. And he said, maybe, but, why don't I might be able to get up and down regular way on this thing. Because we were talking, I mean, he didn't disclose that to them, but he said, I've got something I'm working on, might be able to get this done, regular way. So,
which is just buy it.
Yeah. Just buy it rather than operate it on the bank's behalf. So, so we announce our deal. We immediately go into scramble mode to figure out how to bid on this White Star asset. And, I think one of the things that was very beneficial for, having his distressed expertise was there was already a auction essentially, and there was only one company that was qualified to bid on it. Now, Farley went anyway, and, they kind of told him like, hey, the bankers, now we're talking about investment bankers who are selling the asset versus the commercial bankers who are kind of
had the loan,
in charge with the loan and trying to figure out how to maximize value on that. So that, the investment bankers always want competitive tension, right? You get one bidder, you're not getting anything. And, we thought that this thing was going to go away for a song. So the high bidder was at 115 million. And when they won that, the next step is you go to the formal auction where essentially all the judge does is hit a gavel and say, you now own this asset. That team was offered the stalking horse position in this bankruptcy, which gives you a ton of advantages. Basically, you get a ROFR on the deal, but, you're a little bit naked in terms of, you've already agreed to a price and nothing can change between then and the auction. So this was an oil and gas business. They turned down the stalking horse bid. And, we would say stalking horse is one of the best protections you can possibly have as a bidder. And we would always want to try and do that if we're, in a position to do so. So, so they had turned that down. So they lost a lot of the privileges that they would get for having that designation. And so, we immediately went into how do we get qualified to do this auction? And, obviously the banks want, the investment banks want us to get qualified, but they also kind of don't want us to get qualified because if we come in and screw anything up, well, maybe they're, the deal doesn't consummate and then they don't, get paid. So, we got them convinced that we could do this. And then they threw us a curveball, 36 hours before the auction and said, guys, this is great. We'd love to let you in. We need you to have backstop financing on this deal. And I mean, we were talking about, this other group's at 115. We were going to bid 125. And they said, we need it in 24 hours. And we kind of went like, guys, we can't do that. And we were convinced that the other group didn't have backstop financing. So that was what we were trying to argue is like, nobody has that. Nobody can get that right now. Well, in fact, they did have it. We found out later, but, sort of serendipity. Travis Goff, who's John's son, was at a breakfast and ran into somebody who, does that kind of debt financing, a different family office. And we tended to focus on equity at Goff Capital, but, family offices are all very different. So anyway, this guy knew that we were working on this deal and said, how's it going? And Travis said, well, I think, we need whatever it was, $80 or $90 million of backstop financing in 24 hours. And he said, I'll do that. And so like literally, I get a call. It's like, call this guy right now. And I called him and, we stayed up all night and got the docs signed. I went, literally signed the docs and hopped in an Uber and headed to, George Bush to fly up to Oklahoma City because I think the auction was at 9:00 the next morning. And this is the last flight out. It was like 8 or 9 o'clock. I mean, I was just scrambling to try and get there. And I'm thinking, if this flight gets canceled, I got two options. Yeah. Well, I'm driving and I can barely get there in time for the auction. So like, I'm going to walk in with no sleep, having stayed up all night. That didn't sound very good. Anyway, luckily the flight took off, got to Oklahoma City. Farley and our attorney, who was really Farley's attorney, he was just kind of working with Farley on the deal. They drove up that morning at 4 or 5 o'clock in the morning. So we all met up and had another call with the investment bankers that morning. They tried to shoot holes through our backstop financing. And after, some hemming and hawing, they kind of let us in, but we had to get our wire in before the auction started, or it didn't matter. We needed to put up 10%. So, I'm on the phone with our CFO, you know how wires go. It's who knows where they go? You hit a button and then they're in ether for, sometimes 5 minutes, sometimes it's 5 hours. And, so I'm just, chewing them out, going, where is the, so anyway, the wire hits about 15 minutes before the auction starts. And our attorney's like, and, he had told us a week before, like, guys, this is not going to happen. Like, this is, y'all have gotten a long way here. It's impressive. This is not going to happen. And he came up and said, guys, I think they're going to let y'all bid on this. And so, we had the element of surprise because, the other group did not know that we were coming. So we showed up unannounced and, slapped a bid on the table for, 125.
And you're at the courthouse.
We're literally at the courthouse, and I can't, like, this was the first, it's obviously not a huge company, but the first like big problematic bankruptcy that happened in oil and gas, because the prevailing thought in the commercial banker community in oil and gas was that first liens never lose money. And if you looked at the loss history over decades, like, that was borne out. Now, you don't want to go back to the mid 80s, because I think, there was a lot of losses there. But if you start right after that, there was this period for most of their careers that nobody had really seen big losses in a first lien. Well, now we're talking about buying this for 125. The other group was 115. The effective date was way back. So effectively that purchase price is much lower than what I'm talking about here. And so you're talking about, even pre-paying all the advisors and lawyers and everybody, you're talking 15, 20 cents on the dollar for first lien, which is, just totally unheard of. And so and when the company was headed into bankruptcy, they tried to drill their way out of it. So not only that, but you also had $150 million of drilling companies, completion companies, chemical companies who were all thinking that this company's okay, that had run up a bill and now became unsecured creditors. So, I mean, there's 100 lawyers in this room. And I mean, all 10, 15 banks had 2 lawyers, every unsecured creditor. And so, our lawyer walks in and, slaps this PSA on the table that was the exact PSA that had been, signed by the other group, and said, we're at 125. And, they didn't know what to say, but they pulled us into a room and said, like, who are you guys? And explain to us where you're going to get this money. And, we went, here's who we are. Here's what we're doing. Unbeknownst to kind of everybody in the room, Farley wasn't officially an employee yet, and the lawyer wasn't officially engaged with us yet. I mean, we were all, and so we're all explaining who we are, and Farley works at Contango, and this is our lawyer, and this is what we're going to do, and let's go. And our lawyer is very convincing. He's very good at kind of bankruptcy court, and again, cottage industry. There's kind of advisors and lawyers and bankers, and they all kind of know one another, and they know how to play the game, and everybody else in the room, I would say, didn't know how to play the game as well. So they came back to us and said, okay, we agree that y'all are bidders, and but we're going to give everybody a best and final. So you and the other group can come back and bid one more time, and we're going to do it kind of closed envelope. We didn't like that. Because our view of the asset was that it was worth at least $175 million. And we thought cash at close, if we bid 125, is going to be, 85, 90 million bucks, something like that. So we knew we could drive a truck through what we thought this thing was worth and this was, prices were, somewhat depressed at the time. They were obviously much worse, the next year, but we knew we had plenty of room. So we were kind of like, let's do open outcry. Like, these guys weren't expecting us. They probably don't have the authority to go up a bunch on, what they're willing to bid. And so we're, we want open outcry.
What is open outcry?
Well, just, and maybe I'm using the wrong term, but literally where you just, we would keep going up in increments until somebody was unwilling to bid anymore.
Yeah.
And so, they did this closed door thing. And so, we wanted to go up more because we were like, look, we really should get this deal. I mean, this is going to be a good one for us. And so we're in the bathroom in the courthouse, called Goff, who's our chairman of the board at Contango at this point, and are, kind of walking him through the math and why we need to go up and how much we need to go up. And, he's like, yeah, go do it. So we're, playing all these games in our head, what do we go to? And I think we went to 130 million. We decided 130, we'd go to there. We didn't think that the other group may be able to go up that high with that, short of a notice period. And we said, well, they might go to 130 and $1 just to, try and tie us. So we went 130 million and $2. So we submit it, and, the lawyers come back a little bit later and said, you guys were really close and you did a great job, but you got outbid. And man, that was dejecting. I mean, we had just killed ourselves for, a while on this deal. And, but we went and got in the car and, started heading back to Fort Worth. And we got to Norman. And for those people who haven't been in Oklahoma, I mean, Norman's probably about 35 minutes south of Oklahoma City. And we get to Norman and our lawyer gets a call, from one of these unsecured creditors and said, do you guys know what the other group bid? I said, no. And they said 130,500,000. And, our antennas were up the whole time because the other group was a Oklahoma City based company. And, the debtor was an Oklahoma City company too. And that's a very tight knit oil and gas community. So, we're kind of thinking like, yeah, I get that these people don't really want, 3 Texans coming in here. And, I guess I call myself a Texan now. I grew up in Atlanta, but Texas is my home
you're
now.
Adopted.
I appreciate that. So, they don't want us coming in here and, messing with, their assets and their businesses. And so, maybe we were being too cynical, maybe not. But, the bottom line was the unsecured creditor said, look, if you guys are willing to go higher than 130.5, I will stall this hearing until you get back. And so, I mean, we're immediately get off, turn around, driving back well above the speed limit. I don't know what it was, but driving back well above the speed limit and, screech up to the building. And, this guy's like, look, you don't have much time, but I'll buy as much as I can. So, screech up to the building. Farley's driving. We're in his car and are about to start running in there. And our lawyer says, guys, I got to go to the bathroom. And we're kind of going, are you kidding me, Eli? Like, you got to go to the bathroom. Can you hold it for a little bit? He's like, I really can't. I'm like, all right, well, we'll run in there. Just make it as quick as you can. So, we run back in the courtroom. Now there's, all these 100 people are all in there. They're, and the ladies, the judge up there who's a lady's, going, we run or I guess this was not the judge. I'm sorry. This was the kind of head bankruptcy attorney said, we've run a full and fair process and, this oil and gas company is the highest bidder at 130.5 and we're ready to announce the sale to them. And, I'm standing in the back and it's literally the lady's about to say, hit the gavel and I didn't know what to do. I mean, there's 100 people in here. I don't know how to handle a bankruptcy court. And so I just raised my hand. I'm sitting in the back and I just raised my hand. And this judge is like, who are you and why is your hand raised in my courtroom? I'm like, I don't know why my hand's raised, but I just need you to slow down. Yeah, exactly. I do have elementary school. I figured I'd try it here. And I'm fumbling through, I don't know, but you need to hold on for a second. And then Eli comes running in and, takes the same PSA. I mean, writes 132.5 on it and slaps it on the table and says, this was not a fair process. We're ready to go at 132.5 and, we're ready to sign right now. Does anybody have a problem with that? And, the judge is very upset at this point. But the interesting thing about bankruptcy is, at the end of the day, there really aren't any rules. So, the goal is to get creditors the best value they can get them. And they may not like it if you come in and do something that you're not supposed to, but they kind of have to allow it. And so, she's going, well, I don't like anything that you guys did this entire process, but if you're at 132.5, then we're going to have to open this back up because I haven't, the sale's not final yet. And so then they, go back, everybody goes back to their corners and, we're about to do, we said, look, if they want to keep bidding, that's fine. But, we're at 132.5 and, we suggest kind of in the courtroom, light of day, no closed envelopes. We just bid until somebody backs out. So they said, yep, we're going to do that. We're going to start in 30 minutes. So then we go back out, we call a board meeting like, hey, how high can we go up here? And so, we kind of talked through that with them and, we had some more room, but it wasn't a ton of room. Then the other company ends up just walking, before the kind of, open auction had begun. So, So we won the deal, went back outside. Farley's got a parking ticket on his car. I think it's framed in his office, as we speak. So, that deal quadrupled our production. And a lot of people, this was peak. This was in the Mississippi lime, and this was peak Miss Lime hatred. It's certainly not a tier 1 asset, but it had a ton of production and a ton of cash flow. And, it's funny, the next week we went up there because part of the deal was, we signed that deal on, I want to say September 26, 2019. We had to close by November 1st, and both groups had to agree, but it was really our issue because this other group had already done a bunch of diligence. We had to close the deal by November 1st, or they were going to charge us $250,000 per calendar day until we closed the deal. So, we basically moved to Oklahoma City for, 5 weeks and, went in the office the next, Monday or whatever it was. And we met with some of the team, some of the technical team, and they were like, look, congratulations, you bought this asset. How many wells are we going to drill next year? And we said, 0. We are drilling 0 wells on this acreage. I mean, not that we won't, but our first focus has got to be optimizing OpEx. And, what you found in this field in particular, but I think you saw this a lot at the time was, people had these big drilling programs. Well, they were trying to build all their facilities ahead of all that. So all the compressor stations and tank batteries and all these things were, biggie size because they wanted to get to, whatever the number is, some massive amount, 50,000 barrels a day or 100,000 barrels a day, something. And we just said, let's cut all that back. And to these guys' credit, that wasn't really their guys and gals. To their credit, this was not really a business model they had ever looked at. But, we cut 25 to 30% out of OpEx. That's turned out to be a great asset for us. And remember, we bought it November 1st of 2019. We were fortunate in that I don't mind taking some commodity price risk, but at the time, it was such a massive asset relative to the size of our business. We really felt like the best thing to do is to maximize your borrowing base, which is essentially how your credit facility is sized. Because we felt like, hey, we might miss some of the upside on this, but as long as I have more money and more liquidity to go buy more stuff, this is, that's a lot more valuable than potential upside to commodity prices. And, luckily we hedged that aggressively. And then, of course, 5 months later, COVID happens. And, we'd have been in deep, deep trouble if that was not hedged. But, even in spite of the fact that it wasn't fully hedged. And so, our 2020 cash flow was well below what we had, kind of modeled. But we paid $96 million at closing on that. And, my guess is we probably generated cash flow of, call it 150 million on that thing, and it's worth a couple $100 million. So, and we haven't drilled a well there. Just to give you an idea of the economics, at least at the time, there were some DUCs there, which are drilled but uncompleted wells. So they've already spent, call it 40% of the dollars for putting a well online. And we still couldn't justify completing those wells at the time, given commodity prices. So, you really wonder, what economics or what type curves were being run to support this investment decision. But yeah, that was the White Star story. And I think it's, we do a pretty good job of being opportunistic. And I think that was a good example of that. But also, again, knowing the lay of the land in a bankruptcy proceeding was really, really valuable to us.
All right. I want to talk about the relationship with Crescent, and then I kind of just want to dig into just what's going on in the market today. But let's start with, okay, we're done with White Horse, and then
White Star.
I keep calling it White Horse, damn it. I just picture Wilkie riding in on a white horse into this courtroom.
Yeah.
Hand raised. All right. How does everything work with Crescent? What's going on there? And then let's talk about the market today and how you're thinking about it.
Sure. So, taking a bit of a step back, that was our first big acquisition. We bought Farley's business, Will Energy, but that was our first big acquisition. And then we made, several more during 2020. All have turned out to be great. And really, it was all about just, are you willing to stomach, can you find the money? And are you willing to stomach the dilution? And, the dilution never really bothered me. I mean, when we bought White Star, I think our stock went up to, I don't know, $3.50, something like that, $3.50. Well, by mid 2020, you remember like all the stocks went up like the first half of 2020, and then all these oil and gas companies at least just got crushed in the second half. So, we're bidding on stuff, we're winning stuff because we're the only guys on some of these unsexy assets that have the money to close. And
why were they unsexy?
Well, I'd say, if people had assets they really liked, they just weren't for sale in 2020.
Okay.
But we were able to buy some stuff that that were bank owned. And I think, banks at the time were kind of like, hey, just get this off of our balance sheets. Like, I'm tired of talking about assets that we own. And, you have these big syndicates of banks. So nobody really has a ton of exposure for the most part in these individual deals. And so, we were able to wrangle some of those things at a time when just, that's the tricky part about when, and you, I'm sure, know this in real estate, but, in the market, when the shit hits the fan in the market, people don't want to sell anything. And that's why it's tough to really capitalize on that. That's another reason why I like the public markets, because there's always ways to capitalize on distress because there are people who are panicking. And I think, businesses tend to do a better job of not panic selling. But, we were targeting low decline, but very unsexy assets and largely bank owned in that 2020 period. And they just wanted to, they needed to focus on their bigger credits and their more, make sure those are okay. And I think there was a willingness, with some things to just dump them at whatever whatever price you could get. Like the Grizzly acquisition we did. I mean, that was a company that had already been bankrupt twice. And so now the banks owned it and they're kind of going, get this out of here. But our stock was at $1.50 or $1.40. Doesn't feel good to raise capital when your stock's down, 60 or 70%. But, it's clear that there was a ton of accretion to our business by doing that. And so, that didn't worry me at all. Certain investors don't look at it that way. And I sort of struggle to see their point of view on that.
What would be their argument?
Well, you raise capital at $3. Why are you raising capital at $1.50?
Yeah.
And my argument would be, well, if Exxon's for sale at $1 billion and our stock's at 25 cents, I'm going to go raise the money to buy it because that's massively accretive to our business.
Right.
Obviously, that's an extreme example, but it's all a relative value game, right? Particularly when you're in the public markets. I mean, in the private markets, it may be tougher to say, I'll price something 50 cents in the hole if, your investors aren't expecting there to be, a 50 cent in the hole deal. But in the public markets, everybody knows where everything's trading every day. So it's, it's kind of like the market therapy is there.
Yeah.
So, we had put a bunch of capital to work. We had bought a couple $100 million worth of stuff by February of 21. But we really saw two things happening. One was we saw that there may be a bifurcation in the market going forward where there were haves and have-nots. And our view was the bank market was going to continue to be very challenged. And we were trying to upsize our facility because we had bought all these assets. And I mean, we're, knocking down doors all over Houston, trying to get big banks to come into our facility. And, they're spending 2 months on things and then coming back and saying, we can come in for $5 million. And it's like, yeah, that's just not, we can't spin our wheels like this. So then we went and said, okay, because I always liked the bank debt market better than unsecured.
Why?
Because banks don't want to own your assets.
Okay.
And distressed investors do in many cases.
Yeah.
So you've got I won't say a friendly counterparty, but you've got a counterparty that is more willing to work with you to work out a solution. And look, I was on the other side of the table when I owned those bonds at, 30 cents. It was like, we're willing to listen, but I'd really like to just get paid off at par, when this thing matures. And I think you've got the asset value to do it. So go do it. So, bank market wasn't going to work. So we're talking to, our investment bank relationships about doing a bond deal. And they're saying, yeah, you're a first time issuer. You're kind of small. You're probably looking at 8 to 9% of, your initial bond deal. And I said, well, that's, keep in mind, bank debt at the time is 3%. So that's a big delta. And we would look at a lot of these companies that had bonds in the market, particularly some of the, I would call them, lower quality investment grade businesses. And I'd look at their credit metrics, and we were better on every single metric. Because at the time, we bought all this cash flow. We hadn't been spending a bunch of money. We had been, banking it and then raising our credit facility. And so at the time, we had really driven our leverage ratio down to half a turn or something. I mean, it was very low. So I'm going, well, how come these guys are borrowing at 3.5% and I have to borrow at 8.5%? So, well, it's size. Size is the differentiator here. So we were like, okay, maybe that's an option, but let's go get bigger. Like, we just need to figure out a way to get bigger. Because if we can get to investment grade and we can keep buying the same stuff that we're buying, which we think we can buy at a higher discount rate just because there's less competition, but we can do it while borrowing money at a much cheaper rate, like, that's going to be a big competitive advantage for us. So we went and kind of met with all the private equity firms down in Houston to, talk through, look, we need more capital so that we can scale this thing. We think we've got a good, business model. We think we've got a bit of a unique business model. But we need a partner, essentially. I mean, there's only, so much that Goff can do. And it was Goff and his, a lot of his ecosystem that was really funding a lot of these deals. And so one of the groups we met with was KKR, and KKR had their Fund One business, which they were, interested in doing something strategic on. And so we looked at that and said, this is a big business here. I mean, it's, a couple $1 billion. And, I think at the time our market cap was, I don't know, 800 or 900 million, something like that, maybe $1 billion. I know it was $1 billion off and on, but, we could really create something here that allows us to, have better access to the bank market, kind of that bifurcation between the haves and have-nots. And then we can also have good access to the debt capital markets, which is where we really need to get if we want to scale this, because the bank market is just going to get a lot smaller. And so we need, the idea is really to use the credit facility as acquisition financing, and then you term it out in the bond market. Now you've got a fully undrawn credit facility, and you can use that for acquisition. So that was kind of the thought process. Now, look, I won't call it downside, but their expectation was, if we're going to merge these businesses together, then we're going to run it. And, as guys who had, a big chunk of our net worth, most of our net worth into this business, all I care about is trying to, maximize the value of our assets. And, there was no social issues. And back to your question about kind of incentives, I think a lot of the social issues that exist because, there's not that same level of alignment. In certain instances, if you don't own any stock and you're making $3 million a year in cash running a business, why would you entertain doing anything until somebody kicks you out? I mean, I don't. It's fairly obvious to me, and I think it's something I certainly learned on the buy side doing investing in public markets, that you didn't find a lot of, and this is everywhere, but just an example. People they way underestimate the power of incentives, and so, I'd have a guy call and pitch, like, some of the parts on this, it's worth 3 times, what it's trading at right now. And I go, okay, I may believe you on that, but, the CEO makes more money in a year in cash than they own in stock. So what incentive does he have to sell off assets to realize your sum of the parts valuation if it's going to put him out of business? Like, he's not going to do that. So it doesn't matter what the assets are worth until somebody can, somebody with an economic incentive here to do something does something. And I think that's pervasive across, the world.
It's human nature.
Yeah. Munger talks about, like, he says, I understand incentives better than he thinks anybody in the world are the top 5%, I think was his quote. And, I've underestimated him my whole life. And I think that's very true. So we did the merger with them. Basically, all of the Fund One assets and all of our assets were combined, created Crescent Energy, which was a nod to John Goff's, his real estate business was Crescent Real Estate. So that was a nod to him. He became the chairman of the board. And then, essentially they're operating subsidiaries underneath the KKR team who manages that Crescent Energy business in terms of the public companies. So they manage, bank relations, debt capital markets, investor relations, equity capital, guidance, SEC filings, all that kind of stuff. And then also shared services, IT, accounting, that kind of stuff. We are an operating subsidiary along with, the two largest ones are ourselves and Javelin Energy Partners. There's also a mineral business that's underneath there as well. But those are the two big operating businesses. And, we like the complementary nature of those two. We're buying lower decline assets that, have much longer tails, but maybe don't have as big of, capital reinvestment opportunities. They're still there, but don't have as big a capital reinvestment opportunities as, other businesses in the industry. Javelin, on the other hand, does, what they call mid-cycle shale development, which is, they're not going to try and pioneer a new play or anything, but they'll go into plays that are fairly well understood and then invest capital in drilling, completion, and development of those assets, but they're much higher decline. So, right. There's kind of a yin and yang there between our assets and their assets that we think's, very complementary. And I think, one of the things that, in my opinion, and I'm not involved in the, public company, but for being, running one of the operating subsidiaries. But, I do think one of the misunderstood aspects about Crescent Energy is, our decline rate is much lower than the rest of the industry. And I think people may have lost sight of that in general in the industry just because all the companies look so homogenous in terms of what they are, because they're all kind of unconventional. And, you gotta keep spending money to keep production from falling off a cliff. And I think, maybe that's not very well understood in our business. So, we operate an operating subsidiary. Like I said earlier, we're always very long-term incentive focused, but now our long-term incentives are tied to the performance of our assets versus the entire, public company and all the subsidiaries.
You've dealt with analysts and you understand the public markets obviously really well now. Like what you just said, people don't understand that we have a lower decline curve than our competitive set. You're obviously saying that. It's probably in the shareholder letters. It's probably... At what point does the market understand that? Is it why wouldn't an analyst pick up on that? And how do they eventually, even if it's related to this or really any company that's misunderstood?
Yeah, it's a great question. I would say, we when we were standalone Contango, we had one analyst. It took us a while to get one. We were real proud of having one, and she was a great.
And you get one. You talk to all the analysts and say, somebody please just cover us.
Yeah.
Okay.
Yeah. And certainly for that first one, it was like, hey, I don't need, JP Morgan to be the first person making up because they have no interest in covering this. There's not a lot of float and all that. But I think you can go to some of the smaller investment banks and kind of pitch, hey, if you're early on this and we're right, then you're right. And, that's when people can really make, your clients can make a lot of money and you can really, hit it out of the park in terms of your career development. If you're the first person making a call on a business, now it's, riskier.
Yeah.
But, if you can convince somebody, hey, being early is going to be really beneficial for you here. And, but it's a much more difficult business to model and to value, I think, because we would say, yeah, we've got capital, we've got places to redeploy capital, but the main place we're going to focus is on inorganic, because if I've got, drilling inventory that is HBP'd, I have time to go develop that. I'm not going to have time to pick up all these distressed assets when the market turns around. So I want to focus on that right now. But that's not easy to model. So they just say, okay, well, what's your decline curve? Let's keep G&A flat or even inclining, and we're just going to decline your production like a PDP blowdown. That doesn't work. I mean, if you're really doing a PDP blowdown, we would have needed to cut G&A substantially to make sure that, most of that value and most of that cash flow would actually go to shareholders rather than being liquidated into the hands of G&A. And so, they'd say, well, how do we model it? So, well, we're going to make acquisitions that are accretive, and that's how this is going to become a bigger and bigger company. And that's just not easy to model.
Yeah.
What is easy to model is if I had 10,000 acres of land and I had a type curve, then I can hand it to the analyst and say, we got 2,000 sticks that we can drill here. We're going to run 3 rigs and, throw it in your model, and you're going to get a really nice, neat number that pops out. And that's what people, it's not easy. It's pretty complicated, Excel modeling, but that's the industry standard. So everybody knows how to do that. And it's very easy to have a really neat, PV number that looks really big if you do that. It works every time. And so I think that's a really easy business to pitch as a sell side analyst. Ours was much more difficult.
But if you hand them your model and say, well, start telling people about this model, do analysts tend to be hesitant and say, we still want it to be our model? We can't trust your model.
Well, yeah, we couldn't hand them our model. You've got all sorts of, restrictions around that. So
got it.
They need to put together their own model. We can answer whatever questions we can.
Interesting. But,
obviously if we deem anything material, we need to file an 8K to let everybody else know that. So, you can't hand them your model. I think, look, we're a unique business, at least in the upstream space, be it Crescent. We're new, it's a structure that is not typical in upstream, but I would say it's typical in REITs and, private equity, and, there's tons and tons of capital that's in these types of structures. And so, And by the way, KKR controls the vast majority of shares at this point. So our view was, they effectively control the company right now. So what difference does it make if it's formal or informal? And if we think they're going to be able to sell the story, and over time, you're going to get new shareholders who believe in the story, and that will by definition, dilute the rest of us down. But we're fine with that. That's what we got to do if we're going to continue to consolidate and use this balance sheet to really scoop up assets, over the next 5 or 10 years while you've still got a lot of noise in the market.
All right, let's just spend a little time here. I was having lunch with somebody the other day, and they said something like, you could tell the world that you own a business in the porn industry, and they'll like you more than if you tell them you own an oil and gas industry. Do you have any optimism, or what's the current temperature or optimism that capital flows will come back into fossil fuels, or is it going to get worse before it gets better? Or does it ever get better again?
I don't know if it gets worse before it gets better. That's always tough to tell. I've always found I'm everybody, but I'm much better at trying to figure out what things are going to look like 5 or 10 years down the road than 6 months. I'm really bad at that. I think most everybody is, whether they tell themselves differently or not. I think the longer term is easier to see. And from my purview, first off, having a lower carbon footprint and a lower environmental footprint and being safe is, we think very important for any business, but certainly for oil and gas.
Yeah.
And I think, oil and gas didn't do a good job of that for a while, and they didn't worry about it. And now I think people are focused on it. And, we see no incongruity between being able to, operate older assets and do it in a, safe and environmentally friendly manner. So our view is always, let's make this asset better than it was before.
Yeah.
And the flavor of the things that, we buy is typically either something is distressed or something that was owned by a very big company that didn't really focus on it very much. And I think in both cases, we're able to put some TLC into that, to say either they didn't have the resources or, capital resources, or they didn't have time. And in either case, I think we can go in and invest the time in understanding how do we operate this responsibly and, do methane flyovers and try and, retrofit your tank batteries so that, your spills are less likely and, things like that. I mean, they're not big dollars, but they're impactful, on your ability to operate in an environmentally friendly way, in a safe way. And, that's really important. On the alternative energy side, I mean, where you are right now that's the topic du jour, and I think it's two reasons. One is, everyone would think that, if we could be solely powered on wind, then maybe that's a lower carbon footprint. It's tough to tell, frankly, but I would agree that, if that was possible, it's probably, a lower carbon footprint. Now, again, you got to build the big windmills and how long those things actually last and what happens when you junk them and all that stuff. Those are difficult questions to answer. But, I think there's a desire from everybody's standpoint, but particularly people who are not, well, I won't say particularly. There's a desire on from everybody's standpoint to do this in a more responsible way. Now, some people would say oil and gas is bad. I don't want anything to do with it. I only want, alternative energy. And there's two problems with that. One is, I think the incentives are in place right now to where you're misallocating capital. So, whether it's wind or solar or geothermal, those are great options for certain areas of the world. But you can't just say, if we put a wind farm everywhere in the world, it's linear. So if it works here, just do it 1,000 times, and then we're going to be able to power the United States. I mean, there are areas where the wind doesn't blow. I mean, that should be obvious, but that's something that you need to think about. But if there's a ton of capital flooding, and then there's a bunch of government incentives to try and, incentivize development, you may put things places where they don't need to be.
Yep.
But it makes you feel good.
Yep.
And I think we need wind, we need solar, we need geothermal. We need to focus those in the areas where they can have the biggest impact or the highest utility, because we're going to need all of it.
Yep.
We're going to need all of it. So, and oil and gas are going to be a big part of that. So, I think people are going to have to accept a lower return in alternative energy for the most part. And if you're not reinvesting any money in the, at least right now, the best bang for your buck, be it oil and gas, those are the most efficient ways to power homes and cars and everything else right now. Now, again, maybe in the future, you're going to have a better answer, but, starving an industry of capital when it's the most efficient way to power people's homes and get them to work and all that is not a good answer.
Yeah.
So, my view has always been, look, we need to have a rational discussion about this. And I think it was Mike Wirth at Chevron that said, it's not wind or solar or oil and gas. It's all of the above.
Yeah.
We need all of the above. And particularly in developing countries. I mean, you think about, even natural gas, like the amount of infrastructure that's required to really power a country with natural gas, which we have here in the United States, and it's great. That's just not all that feasible in, Africa right now. I mean, the energy density of petroleum is just much, much higher than natural gas. Now, maybe we'll get there over time, but, when you've got people, burning dung as their energy source, that's not nearly as good as oil. Yeah. And I think, the way the thing that I think the world needs to be most focused on is how do you bring the most people out of poverty? And that's cheap energy, period. End of story. Cheap energy is the answer to everything. And I think people have taken their focus off of that. And, again, we need to be responsible, and we view being a responsible operator as, your entry cost into being allowed to be in the industry. But until there's a more rational discussion about what is needed and what's realistic, my guess is oil and gas prices keep going higher. Yep. Because until that happens and you have people focused on, deploying the amount of capital into this industry that is needed, to help power the world's growth and to get people out of poverty, prices are just going to keep going up because supply is going to be constrained.
Yep. Yeah, I don't think it has to be a transition. It's like you said, it's all the above. The word transition makes it seem like we have to get off one and get on the other.
And we haven't seen any of the unintended consequences yet. I mean, people talk about them a lot now, whether it's lithium mining and all that kind of stuff, but you just don't know yet.
Yeah. All right. As you look at if we just take America, there's a lot of talk on demand, but where is all the supply going to come from? Is the Permian? It's kind of, again, from somebody on the outside looking in, just reading, is like, we kind of know how much oil's left in the Permian. We think tier 1 technically has been drilled. Like, where else will supply come from?
Yeah, I mean, it's a good question, because shale has really been the majority of the world's supply growth for, a number of years now, and it's running out. Now, are there shales that are prospective for oil and gas in other countries? Absolutely. But it's not that easy because nobody owns their own minerals in other countries. And obviously you've got lots of governments who are now very hostile towards oil and gas. So I just, you can't see that type of, production growth that you saw in the US. The countries aren't as commercial. The property laws aren't as well developed. And then again, I think the most important thing is there's no mineral interest private ownership, which really drives a lot of that incentive to develop.
Yep.
So I don't know. We'll figure it out. I mean, again, it goes back to the all of the above. But I think what's going to happen is you drill all the tier 1 locations and those do great at, $70 or maybe even $60, maybe even $50. I don't know. But once you get done drilling those, now you got to go drill your tier 2 locations, and you're spending the same money or maybe more, but you're getting less yield. So your type curve is going to be lower. So your lifting costs on a DNC basis is going to be, let's say it doubles or it goes up 50%. Well, I think what's going to happen is you're going to see people continue to migrate from kind of tier 1 to tier 2 to tier 3. But by definition, the only way to do that is if the price is at a level that, incentivizes them to drill their tier 2 and tier 3 locations, because they are less economic if you leave price flat. And then the biggest thing, I mean, the biggest thing to me, back to the all of the above, is nuclear. I mean, I think that's something that, is just a really interesting history of nuclear energy. I mean, there was, 2 different predominant technologies. And the one they ended up going with was really the fusion that was, in a very pressurized container. They did it because the plutonium that you're creating was weapons grade. So, you can kind of create this plutonium not just for power plants, but also for nuclear bombs. And that was where kind of the fork in the road, that was the direction they went. Well, I think, there are safer ways to develop nuclear power. Now, are they as well developed? No, because nobody's put capital into them in a number of decades. But I think, that's starting to be a big focus area for, there's a number of competitors out there that are playing in that space. I certainly have, my opinions on that, but, the reality is they're all, somewhat, immature. But I think in the next decade or 2 decades, that's something that I think can be figured out. And I mean, you talk about the greatest, gift to the world that could be invented. It's, safe nuclear power. And I think it will get done, and I think it'll happen in our lifetimes. I may be wrong, but, if you think about that as a real transition fuel, I think we've got time to get to, I think we've got plenty of time to get to that spot. And to me, that's really, it's not the only answer, because again, we're going to need all the above for a while.
Yeah.
But to me, it's the best answer.
It fills the biggest gap. Why do you think someone like Elon Musk hasn't paid attention to it? And he's focused on batteries with how smart he is and how obvious, not just you, but a lot of the conversation is like nuclear is pretty obvious to a lot of people. You could say it doesn't fit some of the agendas because it can't be weaponized as much, I guess. But why would somebody that I guess everybody looks to like Elon as the savior of energy, why do you think he's put like no even words behind it really? Do you have an opinion?
I mean, it really is a great question. And frankly, it's one that I've thought about, and I don't have a good answer for you on that. I mean, obviously he's got a big bet on EVs and batteries.
That's probably it.
There's a lot of incentives there to see that through. But I wish I had a better answer for you than that.
All right. Last question on the industry. Is there anything as it relates to upstream, like technology wise? We had fracking, whatever it's been, 20 years or something like that. And correct me if I'm wrong. When we drill oil out of the ground, even if it's fracking, not 100% of it comes out.
No.
Even in like 80% of it's still left in the ground, something huge.
More. Well, and unconventional. I mean, if you look at primary kind of conventional development,
right,
you can maybe get 15, maybe 20. But if you're talking about unconventional, where you're going down and fracking and drilling horizontally, it's in the single digits.
Okay, so there's this great argument that like it's not that we're running out of oil, we're running out of technology to get oil out of the ground. Is there anything like even cool going on that could say there's something that's going to come that can get us another 50? If you could just get another 15%, you've basically recreated the industry again.
Yeah, that's right.
Cool?
Well, there are some things people are trying. I mean, EOG is kind of a, always thought of as being on the leading edge of technology in the industry. And, I have a ton of respect for those guys. They're very secretive for the most part. They don't really talk about what they're doing, but I know in the Eagleford, they were working on, essentially they call it a huff and puff, but it's, it's basically a, enhanced oil recovery technique on their Eagleford assets. Now they were working on that apparently, I don't know, a year, 2 years ago. Jury's probably still out on that, but, something like that could be very interesting. And so, not that we're going to pay for it, but, if you think about buying, unconventional assets like a White Star that may not be, in the best basins, that's kind of a call option that you're buying too. Yeah. Right. So I think there's things like that. And look, people always say we're running out of oil, right? We're not running out of oil. We're running out of, what they mean is we may be running out of oil that we can economically produce at this price.
Yeah.
But until we find a substitute for the actual commodity, prices are just going to adjust to, whatever the capital cost and the cost structure of the business is to produce the amount of oil that the world demands.
All right, I kind of want to bring it back where we started. I have two notes that I've just been staring at since we started, and then we'll bring it home. The first was you started in the public markets. Obviously, you kind of said there was a period in 2014 where it just became obvious that you were going to kind of go all in on oil and gas for a while. But before that, you had been a generalist. When you and just in like the conversations we've had at lunch and things, it's obvious to me you understand business really well. When you're looking at an investment opportunity, industry agnostic, what are things that are happening in businesses that get you really excited to say, I should pay attention to this?
Yeah, I think that's very much stylistic in terms of, what that answer would be. I will say that I talked about earlier. I mean, I just kind of by nature am more of a contrarian. And so
were you taught that, or you've just always been a contrarian?
I think I was taught that at Goff Capital, but I think it was something that was, I was always
easy.
That was the way I kind of always was. I just was able to learn it in a business sense. And so I've tended to find that I can do pretty well in cyclical industries, because there's a lot of panic when things go wrong. So the other nice thing is I don't I don't necessarily have to go dig into a company that stock's been doing this for a while, right? I mean, there's a lot of things that do that for a while. I mean, everything, goes up over time, or the market goes up over time. Most companies actually go down over time, but the winners more than make up for the losers. So that's why you see the S&P kind of over time doing this. But that makes it a little bit easier for me as a, whether it was a Goff Capital or kind of my personal, investing, which I still like to do and have kind of a passion for that. I don't have a lot of time to dig through thousands of different companies. So it's easier for me. And even at Goff Capital, again, small staff, it was easier for me to be reactive. So oil's gone from 100 to 50, and hey, the stock's gone from 12 to 50 cents. The market's pricing it as if it's going bankrupt. Let's dig in and see whether it's going bankrupt, because if it's not, it's probably going to go up by multiples. And I that's another thing I tend to like to focus on is can I buy something that I can hold for at least a decent amount of time, so I'm not paying, short-term taxes on it, and then B, is it something that I could see being a multi-bagger, because that can make up for a lot of mistakes if you're right on one of those. Now I've there are other businesses that, for one reason or another, I love the idea of kind of, focusing on these high quality businesses, and, you just buy it and forget it, because, it takes me the same amount of time to analyze and assess an idea that I can hold for 6 months as something I can hold for 10 years, but there's a lot more value in the latter, right? So, I'd love to find these businesses that are cheap and high quality. They're just, they're much harder to find. So, I do a little bit of that, but I would say, most of the success I have had has been, dive into a cyclical business when everybody's headed for the exits. If you're the only guy running into the burning building, you don't have to be the most knowledgeable person to know what to do, because you're playing off psychology. There's a lot of things outside of maybe industry knowledge that you can bring to bear. Like somebody who's a read analyst right now, they're probably looking at stocks that they say, this is an amazing stock, but it's down 80%. I have no credibility with the people I'm talking with anymore, because I told them to buy it, when it was 5 times higher or something. And that's an extreme example, but that's what happens. So you get these people with tons of industry knowledge, or maybe they're a, hedge fund manager who focuses on REITs, or they, run a private equity firm that only focuses on office buildings or something. You have the most knowledge, but you have all the scar tissue, and you're managing problems, and you're just trying to figure out a way to make it to the next day. And if you can step into an industry that's just in disarray, I think there are a lot of advantages that you can have without maybe being as smart as everybody else is.
I love that. All right. I want to bring it back to Goff. He was, from my understanding, worked under Rainwater, and Rainwater has this prolific history of creating a lot of the world's great, or the country's greatest investors, maybe the world. And then you kind of said, I went to Goff and I just got to hang around the hoop, and I was a young guy. Very similar pattern to how, what did you learn from Goff? What has he taught you? But also, like, one day you're going to be Goff's age, and, God willing, your career continues to take off. What is the magic of that idea of letting young people come in and hang around the hoop that kind of take the ball and run with it? It seems to have been a unique pattern in kind of this lineage of folks that keep coming out of the system.
Yeah, I mean, I would say the first thing is really intellectual freedom. I mean, I and even when I was, super green, super green, didn't know anything. I didn't sit there all day with a list of tasks that he wanted me to do. It's like, go do this and this and this. And, you do all these, rote tasks, and you clock out at the end of the day and you come back the next day. There was never any of that. And, I would say early on in my career, I wasn't very productive. I mean, that's kind of the downside of that. But it's, his view was, you're here to create value, and, let me know when you see it. But it wasn't this thing where it's like, hey, if you haven't come up with an idea this week, like, I'm going to give you a talking to. I mean, you go months and months, if not a year, without coming up with anything. And there was never this pressure to put money to work just because I have it, or I want you to prove yourself. And so, it was, we'll go anywhere, we'll do anything, but we're looking for value and we want to make returns and have some fun doing it. And so that allowed me to look at a bunch of different things, a bunch of different industries. Sometimes I'd spend a year on an industry and come back and say, yeah, there's not really anything interesting to do there. And rather than saying, well, hey, you just wasted a year of, my money that I was paying you, it was great. Let's go find something else to do. So, that was a big thing for me. And then I think the other thing, and John talks about this a lot, about how, when Rainwater hired him, he wasn't quite sure kind of why. He had worked with him, but he was an accountant. And he says, Rainwater believed in me more than I believed in myself. And I think, that is certainly been my experience too. I mean, there were times when I felt like, man, I don't know if this is going to work out. And, he's just a huge cheerleader of saying, just stay focused, keep your head down. And I think that helped me immensely. And then I think the other thing that, that's going on there is, I'm in an office every day with, I'm assuming this is the same way with Rainwater, but I was in an office every day for 10 years with John, and he's kind of this, very well-respected and almost kind of mythical person in a lot of circles about, how he's been able to do deals and make money and kind of follow on the legacy of Rainwater. But, I was in a really unique position to see, he's all that and more, but he's also a regular guy. And, he has problems and solutions and, bad days and good days. And, so that really taught me like, hey, yeah, I get it. John's really smart and really good at a lot of things that maybe I'll never be as good at those things, but maybe there are other things that I'm better than him at. And there is no reason why I can't do what he's doing. And that was kind of my view. And my guess is once he spent some time with Rainwater, he kind of said the same thing. That guy does some great things. I do some great things. There's nothing inherently stopping me from getting to where he is.
Yeah.
And, I talk a lot about, the key to life is low expectations, but that's really for your expectations of other people.
Yeah.
Your expectations of yourself have got to be really high, but, you're going to be really happy if your expectations of everybody else is maybe a little bit lower.
That is a perfect way to end the conversation. Thanks so much for joining me today.
Thanks for having me, Chris.
This is awesome.